At Trac.vc, although we spend a lot of overhead and resources to buy data and have data scientists, but we don't have to have an army of analysts because our technology is doing that for us. It's like an army of analysts.
In the future, in the near future, do you see any scenario where one of those use cases is VC itself? Like you mentioned, you're a quantitative VC fund. Do you see a future where LPs skip the middleman and just use algorithms to find investments? Hi, everyone, and welcome to a new episode of the VC React podcast. Every week, we bring you insights and reactions from top VCs, LPs, and angel investors reacting to the latest news on startups, VCs, and investment rounds. Let's jump into it with our amazing guests for today. Brant, Meyer, partner at Trac.vc and an ex-FBI analyst. Elliot, Denham, head of programs at Oraseya Capital, and my co-host, Jamie Laird from FWDstart. In the video description, you can find more details on our guests, their LinkedIn profiles, and links to their companies' websites. This episode is brought to you by OCTA, the AI-powered finance automation platform built for modern businesses. Managing receivables is not one task. It's dozens of repetitive ones. Correcting invoice details, updating PO numbers, following up on payment status. It's operationally critical, but painfully manual.
OCTA changes that. It helps you automate your financial operations, starting with accounts receivable, so you can focus on what you're actually good at, growing your business. From contract to cash, OCTA's AI agents handle everything: invoice creation, reminders, dispute resolution, payment tracking, reconciliation, even financing. You don't need to learn how to use OCTA. OCTA learns how you work. It adapts to your SOPs and existing workflows to get the job done. Finance teams at Careem, Lean Technologies, and Algrim rely on OCTA to reduce admin time, speed up collections, and unlock cash flow.
If you've heard of them before, you know that they used to say 100 companies use OCTA. The number is now 500. They are moving fast. And that kind of growth only happens because the problem is real and the solution actually works. Automate the finance work that slows you down. See how at weareocta.com. Our weekly news are brought to you by FWDstart, a twice-weekly newsletter that breaks down what's happening in the MENA startup, VC, and tech space. Welcome to the show for the first time, Brant and Elliot.
Thanks for having us.
Pleasure to be here.
Jamie, before we get to the news of the week, I hear that you have something big you announced yesterday, a playbook for VC. Yeah. Can you tell us more about it?
Yeah, we published first edition of a new sort of long-form deep dive kind of strategy playbook series called the MENA VC Playbook. The idea, we're doing another concurrent one with founders at the moment as well, is to kind of democratize access to information from some of the best VCs in the region on a variety of practical topics that generally we think are kind of underserved, maybe from a media perspective regionally. So the first of those is deal sourcing. So looking at generating inbound, how to handle outbound, branding, all that kind of good stuff. Look, I think there's tons of great information in there. Most of it comes from the VCs as opposed to myself. There's a small bit of editorializing in and around it, but yeah, if you're interested in checking it out, maybe link in the description, and there's a free trial that you can sign up and have a read.
Great, thank you so much for sharing that, Jamie. And what do you want to start with today?
Well, we start in Tunisia. Well, we're actually two stories in Tunisia, but we'll start with. I think the theme of today is serial founders as well, to a certain extent, and yes, we'll get to Kanuni shortly as well, which is a startup that I'm quite interested in, and I've sort of been waiting for quite a while for a legal tech sort of startup play to emerge. But in any case, I'm getting ahead of myself. So we'll start with Thundercode. So it's Paris, Tunis-based. They've raised $9 million in seed funding, and it's founded by Careem Juini and Jihad Othmani. So they're the team behind Expensia, which was one of the biggest exits that we've had in Africa, full stop. So it was acquired by Swedish procurement platform Medius back in 2023 for a reported $120 million. After that particular deal, founding team, they joined that particular company and oversaw the integration of companies. Basically, that this particular company, Medius, went on an acquiring spree, it seems. And Careem in particular seemed to have been responsible for integrating a lot of those companies within Medius. And one of the main takeaways, I think, was that QA was slow, manual and brittle. And so not long after, he's gone out on his own again with Jed, and they're starting Thundercode. And the idea is to replace that sort of process with autonomous AI agents that test like real users. So they'll flag UI bugs, they'll review the specs, simulate flows, offer product feedback, etc. And look, the pace of this all seems super quick in terms of, I think the product shipped in 6 weeks. They mentioned they have company like product, it's live in the US, France, Tunisia, Canada, starting with web apps. Fantastic cap table as well. You've Silicon Valley, Django Cap, some cool angels in there as well. Obviously, Careem from InstaDeep, another massive Tunisian success story and exit a year or two ago. And look, there's a good, I'm hoping to interview Careem actually at the start of July, but there's a very good interview with Quain from RallyCap, his podcast with Careem from, I think it was back in March. That's well worth having a look as well in terms of the story of Expensia. So heartily recommend checking that out as well.
Let's start with very simple reactions. Any thoughts about or on using AI to replace more traditional roles like QA? Is it exciting, risky, or both? And as investors, how do you assess the market readiness for such products?
Yeah, actually, the thing I was thinking of before that question was, we just went over the VC playbook. And when I see a $9 million seed round from a second-time founder, it's like he read the second-time founder playbook, because that is a huge round, especially for a software product. So more power to him. And when I've seen deals like that, I think to myself, he knows how to fundraise. He's been through this game before. And if I had to guess, he's probably pre-baked a lot of those investors before he was officially raising. And so the thing that just struck me first off was that amount of raise in a seed round for essentially AI software is really high, not just for that part of the world, but for here in San Francisco. Today was YC's demo day, and I don't think there's any company there raising more than $5 million seed round, and some of them are building satellites. So that was just the first thing that struck me. But to your question in terms of how do we evaluate those, I think the hard part is, and I think this is why this round probably is so big, is it's so hard to differentiate between some of these AI software solutions. But what I know for a fact is this guy's built a company and had a huge exit. And so I think that's why he's going to have a lot of the momentum, not just on the product side, being able to bring people from his previous company. I think that's a lot of the differentiator is, can he get the people? Can he get the capital? Can he tell the story in a compelling way to where he can get enough speed and momentum going that he can outpace his competitors? So that would be my evaluation if I were looking at it more so than the nuts and bolts of the actual product he has here at kind of 6 weeks in from shipping.
By the way, Brant, this is not the biggest seed round we've seen. Actually, I guess we've seen a bigger pre-seed round. Do you remember, Jamie? There was a $10 million pre-seed round.
I mean, but that's big though. That is still big for you guys over on that side of the world. Is it not? Okay, it's not unheard of, but it's still large.
Yeah. Elliot,
it's particularly large. I was going to say it's particularly large considering, as Jamie alluded to, they ship product in 6 weeks. I mean, honestly, that's really phenomenal. Not just the product tailwinds, the market tailwinds, the timing tailwinds, but the reputational tailwinds. So, when you've had that such a significant milestone in the past. In fact, I was doing some reading beforehand, and I think it mentioned that Careem, the founder, had sworn not to go back into the world of entrepreneurship. He was done with it after his first deal at Expensia because of his significant reputation and a milestone in the past. That really feeds into the fact that he can, as Brant alluded to, bake the round with his existing investors that perhaps have him on a pedestal to be able to move quickly. But I think my other reaction, other than the fantastic amount of money that he's raised at such an early stage, is that we're going to see more of this. I truly expect to be seeing many more AI agents in not just QC for coding, but all walks of life, all problems that typically take hours and hours and hours of huge expertise that perhaps is outsourced to specific agencies. to be automated to a degree and operated by a machine to the point that non-tech individuals can have access to some of the world's best specialist knowledge in the form of AI much quicker and be able to implement it as if they, as if they had the knowledge themselves. So I think this is going to be a more reoccurring theme, that these sorts of problems will be addressed by agentic AI solutions, not necessarily all raising 9 million, but nevertheless, the two fantastic results.
Considering their rapid product launch, 6 weeks in, and they have customers in 4 countries, what's your take on the balance between speed to market and product maturity, especially in technical and AI solutions like these ones that honestly, from my point of view, could be replaced by another startup that would pop up anytime soon? And I've seen 2 other companies doing something similar.
My initial reaction to that is depends who you're selling to. If you're selling to SMBs who can make a quick decision and buy on a credit card and get quick results from payment to impact, then it's okay to have something that isn't necessarily polished 110%. But at the same time, if you're selling to enterprise, you're probably not going to even be able to close the deal in 6 weeks. So the expectation management on the tolerance of the ICP is very important, but the time to impact is the real litmus test of that. So moving fast, getting feedback is a fundamental, reality that founders ought to be adhering to. If they're not, and they're trying to find and build the most polished product, then indeed, most likely there will be a competitor that is able to move faster. But getting to any form of dollars in your pocket nice and early is certainly a positive sign.
Definitely. Brant?
Yeah, I think, kind of to echo what Elliot said, the thing I've seen with a lot of AI agentic software companies is they get, and I think it's from selling to SMBs, like he was saying, they get very quick revenue in a very short period of time. And then it kind of levels, or it never kind of breaks through that next stage when you have to have these kind of large enterprise contracts. And I think the speed at which you can go from 0 to recurring revenue that would have taken you a year, 3 or 4 years ago, you can get that in 6 weeks or 6 months. But it fools you because the gap, though, to those big contracts and the big revenue to taken off is still, I think, just as big. And one thing I've noticed, I'd be curious y'all's thoughts, what you see over there is, about a year and a half ago, I was seeing a lot of these types of companies, and it would be like, here's an agent that can do anything for any business for any task, right? And it'd be like at best a 60%, 70% solution, but no 100% solution on any particular thing you wanted done. And then over time, what you start seeing is like super, super, super specific use cases in the hopes that they can 100% take that problem off your plate for good. 18 months ago, it's like personal assistant, agentic things. And now it's like back office management for veterinarians with between 2 and 10, whatever, fill in the blank, And so I'd be curious too with like something like Thundercode. It's the question of like, and all companies like this, how quickly can they get to a true 100% solution, even if it's narrower? Because I think that's really the key, kind of what Elliot was saying, of like to be able to close those bigger deals.
Speaking of 100% solutions and 100% being managed by AI, Trac.vc is 100% managed by AI or machine learning models, right? You keep saying that the machine makes the decision and you're just the face of the machine. In your data model, how important is being global from day one for the company? Like, for example, in this case, in Thundercode, they have clients from the US, France, Tunisia, and Canada within the first month, 6 weeks. How do you measure that? And how important is that for you?
Yeah, I wish I had an answer to that question, but I am limited by the availability and the sources of data that I have that are heavily weighted towards US-based companies. And so I'm not dodging the question. It's just that I don't have enough data to really give an answer, because although, we are completely algorithmic based, there's still bias in algorithms. And so I'm biased by the data that I have. So, and that's why we've been limited to kind of the sandbox we're playing in, which is typically North America, Western Europe, because that's where I have the most data on venture-backed companies.
Having US customers doesn't make them a US company. What defines a US company in today's
Just
global?
Yeah, in this day and age, it's just being incorporated in the US, which, is a pretty low bar, I think, to just be a Delaware C corp. And so we can invest in those companies. So I can't give you a definitive answer on what the data says. I think, part of our models are sizes of markets and saturation of markets. And so depending on what sector you're in, being global matters a lot, obviously. And in some sectors it doesn't. It kind of makes me think too of, I was having a conversation with another VC last night. And we were talking about market maps. Anytime you see like this region of the world ranks this in this sector and this, that. And he was making the point that he actually thinks market maps are a negative signal in the sense that, like, you never hear San Francisco talk about, we lead in innovation compared to these other countries. They're never comparing themselves to other places because they are the leader. And so in a similar way too, I think a lot of times there are companies that sometimes maybe over pursue a global strategy because they don't have access to the biggest, fastest growing markets. But it's also like, you gotta fish where you are, wherever your fishing pole is and wherever the pond you're at, that's what you gotta do.
Elliot, Dubai is a global city by definition. So do you target local companies, regional companies, or global companies, or all?
So at Oraseya Capital, we are a $136 million fund here in Dubai, investing in pre-seed all the way to Series B. I think we're the most broad investor in that nature in the city, if not the country. And whilst we remain sector agnostic and opportunistic from that pre-seed to Series B stage, writing checks up to $3 million, we do focus on startups that have a nexus, a clear strategic relevance to the UAE. That said, the UAE is a great market for opening, for expanding through, if you're coming through from east to west or west to east. It's a great market to test and then expand from and springboard from. But at the end of the day, there's only 12 million people in the UAE now. I mean, obviously it's growing rapidly, but in the game of VC, as we all well know, we want to be focusing on startups that have that local presence with the global mission and the global mindset from day one. I think so many founders that we come across, particularly first-time founders, don't necessarily have that global mindset or that true understanding of what is required from Brant and I and our teams to be able to say, yeah, this is venture backable and this is, venture scalable. And my recommendation to them would be not only to try and find product market fit or problem solution fit or founder problem fit in the geography that they're in, and then only think about the neighboring country that is, half an hour flight down the way or an hour's flight away, particularly in MENA and Europe, but actually be thinking, how do I go from this continent to the next?
I just want to say, could I stick with Elliot for a minute? I just want to pick up on a thread that Brant, you asked a question a while ago about sort of horizontal versus vertical, specifically with regard to AI applications. And you probably have a better idea, Elliot, anecdotally, in terms of the deal flow that Oraseya is seeing, especially via applications to the sandbox as well. What are you seeing in terms of startups sort of in this particular space? Is it vertical specific? Are we seeing prop tech, for example? Is it very defined use cases as it pertains to that? Or that's just one that immediately pops into my mind. I feel like I've seen a lot of vertical specific prop tech in the last couple of months, especially.
If I was to kind of, have a rule of thumb, it would be that we see a ripple effect of probably what Brant sees, but maybe 6 to 12, maybe 14 months later. But I think that's not, you can't necessarily, brush everyone with the same brush. With that in mind, there was a consumer fintech boom a few years ago. There was an enterprise AI peak. There's certainly a prop tech hype or interest at the moment. And that will forever be the case. It's always going to be cyclical. Who knows what's coming next? The key thing is to, at least what we evaluate at Oraseya is there that global ambition? Is there a road to, if not already, a sustainable business model that can last the test of time for, when we say test of time, we're not looking for a quick in and a quick out, but perhaps 7, 10, maybe 15 years that we can have that relationship with the founder. And of course, through all those founders, of course, through a relationship that could last 15 years. In some instances, there's most likely going to be serious ups and downs at macro level. And with that in mind, is there a sustainable business model? Is there a sustainable need for the solution that can fight and fend through that test of time? Is like a way that we certainly like ask ourselves prior to IC and at IC. Right now, there's a lot of fintech play, but I think that's because in Dubai, in particular, as a city, there's a strong tailwind from the state government around making rentals more accessible, maybe moving away from check payments and things like that. At the same time, the development of open banking in the region is evolving quite rapidly. Again, the regulatory tailwinds is something to lean into as founders. So I think that there's always going to be cycles. And I couldn't necessarily say, right, this week it's prop tech, next week it's ed tech, and the week after it's consumer fintech. But we fundamentally, as a sector agnostic investor, ask ourselves, is the market growing? Is there tailwinds behind this, both from a consumer demand and regulatory standpoint? And is this something that can scale in a sustainable manner fairly rapidly and stand the test of time?
And somehow we're seeing those sectors merge. Like, for example, embedded fintech is now in prop tech and in other areas. And AI, of course, is in everywhere and everything. Brant, how about in the Bay Area or in the US in general? Do you see any clear trend today?
Yeah, I think just what I was talking about before, which is like just more and more specific use cases. And I think what I can't tell you where that's going to go. I'm just seeing what's passing. It's kind of through my deal flow funnel and reporting from the front lines. But it's interesting because, when those super specific use case companies go and sell against the kind of broader horizontal companies, they look great, right? Because it's like, hey, we've trained to do this specific task. The fidelity is much higher, and we're going to close that deal. The trade-off is the market's much smaller, right? So this is like a little bit of the battle that I see going on, where like the kind of one size fits all is not quite good enough yet. The very specific use cases have gotten like crazy good. So they can sell, but like what happens when you've sold to every dental practice or every veterinarian or every fill in the blank. And like they just had YC demo day today. And we invest in a lot of YC companies, but it is kind of funny when it's just like, they've got the slide, it's going like up and to the right, and they do some calculation, like, they always say things like, well, if we only get 10% of this market, and I'm just like, how does one capture 10% of a market? Like, you can't really
especially at your scale.
Yeah, I'm just like, yeah, I'm like, yes, if you would be a $1 trillion company if you could, if only. But so I give some of them a hard time, but it is kind of to that point of like, yeah, there's lots of dentists, there's a lot of veterinarians, there's a lot of whatever, and they're solving a real problem, but it comes back to the venture scale outcomes. And that's really, the fundamental thing when you're talking to these founders, which is like, you might have a great business, you may have a profitable business, you may even have investors that you make them good money, but for a venture scale return, for me to lock this capital up for, like Elliot was saying, 7, 10, possibly 15 years, it's like, I'm 46, I'm going to be 60. Like, this better have been worth me with this time and money, and it better have been a fun ride and been profitable. So I think that's something that I think some of the founders are running into, because they can scale up, they can ship product quickly and whatever, but they're just kind of assuming it's venture scalable. And I think most of them are not going to be.
Okay, in the near future, do you see any scenario where one of those use cases is VC itself? Like you mentioned, you're a quantitative VC fund. Do you see a future where LPs keep the middleman and just use algorithms to find investments?
There's nothing technologically stopping that from happening. But the kind of deeper answer, and the reason why you don't see more investors do it like we do, is more of a psychological issue. And the metaphor I always use is like, if you've ever been in like a Waymo taxi, which is like a self-driving taxi out here in San Francisco, intellectually that it should be safer than a human because they're not texting, they're not sleepy, they're not drunk, they're whatever. But the physical feeling of sitting in the back seat and seeing the wheel turn and you not holding on to it is very uncomfortable. Similarly, it's very uncomfortable to meet with a founder for 30 minutes and then wire him $1 million because a machine you built told you to do so. And so I think I think it's certainly possible you'll see VCs like that. I just don't think you'll see a lot of them just because on a human level, it's a very uncomfortable thing to do. But there is one called NoCap. Have you guys have heard of this? Called NoCap. And not only do they make, and they're making really small checks, they also have like a video, like you're interfacing with an AI, not a real person, like during the call, and they're doing it. So, but yeah, I think you'll see it, but not as many as you would think.
I think LPs have a great role to play in the ecosystem. You asked specifically about LPs there, Ahmed. But at the end of the day, they also have other businesses to run and other, assets in their portfolio. VC may be a slither of that. As a result, there is always going to be a place for VCs because they're on the ground, they're touching and they're feeling, they're smelling it every day. They have a very strong pulse as to what's happening around them. And whilst I totally agree with and really quite admirable of Brant's sort of algorithmic approach, the reason it's not automatically sending the $1 million and why Brant and his team are still involved is not to second guess it, but to kind of validate and go a little bit deeper on that human to human level. No least reputation, humility, coachability, character, and things like that. But also ultimately going back to the key point of returns, because all investors are on the business of exits, and it's a side note, but all investors are on the business of exits. Then can I work with this person or these group of people? Do I have the confidence that they are going to be as persistent and resilient in the tough times, as well as riding the wave when the momentum is behind them for years and years and years to come? And that is going to be very, very difficult for either an LP using pure data without being on the ground to manage, and or just a machine to be able to judge without that human intervention, in my opinion.
Makes sense. Okay, now let's shift gears from coding to law, and let's talk about the growing field of legal AI. Jamie?
Yeah, let's just keep talking about very specific use cases. Community. So as I mentioned at the top, legal tech startup out of the UAE, they've just raised 2 million pre-seed round, backed by Village Global, RX Funds, TA Ventures, and a number of angels as well. I guess from my knowledge, anyway, it seems like a lot of the global tech space kind of focused on top-down AI platforms. Like the one that always comes to mind is just Harvey, which is kind of built for big law and kind of sold at the enterprise level. But Community seems to be taking a very different approach. It seems to be very much like bottom-up workflow native tool that meets lawyers where they already are, which is inside Microsoft Word and Outlook. Essentially helps legal professionals draft, review, edit documents consistently. So it applies like AI to adapt their tone, formatting, house style, rather than asking them to actually adopt entirely new tools. So there isn't that same, I suppose, learning curve involved. We mentioned serial founders at the beginning of the episode. So this particular startup is founded back in 2024, but Anusha Iqbal and Ziad Ahmed, they were previously the co-founders of Spotty, which is a Dubai-based buy now, pay later startup, which was acquired by Zip for $16.3 million back in 2021. And then I'm unsure of the nuance of this, but seemed like there was a spin-off then called Spotty in the box, which then was acquired by Nimcard. I think it might have been in 2023. So they took that sort of tech and a Saudi buy now pay later license as well as part of Nimcard's kind of move into credit on demand. And then, as you'd expect, the domain expert in all of this, who has the kind of the legal firepower, is Careem. So he's the founder of Legal Intro. He's a former senior lawyer at one of the firms in the region. It seems like they're focusing on the UAE and the UK. So they've name checked both of those jurisdictions, which I think is quite interesting. But I'm curious, I think off the top, like what we think about embedding directly into existing workflows like Word and Outlook, like from an investor lens, like how defensible is that wedge?
We've invested in a few companies that have done that, and the jury's not back yet. They haven't done great. I think the hard part is like whether it's defensibility or even the psychology of the people you're selling to. I get the point on the one hand, it's like, hey, I don't have to use a new tool, it's already embedded in my tool. Yet the flip side is, because it looks so much like my tool, why do I have to pay extra?
Yeah.
So there's like some weird thing of like, I want to see like a new platform or new button to justify the cost of you selling it to me, versus like, I just opened up Word and it's like doing things. So I think sometimes there's that gap between what makes logical sense, but then in practice, how the people are going to buy it. I don't know. That's my kind of 2 cents on that.
Yeah, I think for me, being where your customer is always good. Low barrier to entry. If they're using Outlook and Word, and there's habitual tradition in that, let's say in the professional culture, that these tools are bread and butter, why try to recreate the wheel? So I think that's useful. The time to impact, which I mentioned earlier, is also something that I think is in their favor for Kanuni. Because again, it's where your customers are. It's where the actual users are. The buyer may be the partner of the law firm, but the actual user, the analysts and associates, and potentially higher. The barrier to entry is super low. So that time to impact, I think, is in their favor. Ultimately, going back to Brant's point about specific use cases in AI and niches, this is an example of that. And hopefully the business will then expand, and the founders are former lawyers as well, so they really truly understand the workflows and whatnot of their ICP. But on the flip side, I'm sure Microsoft are sitting there very calmly with their thumbs twiddling, going, okay, well, which sort of legal GPT wrapper is going to win this space, and we'll acquire the best one. And so, the Kanunis of the world are probably not biting off any of the Office and Outlook suite revenue from Microsoft at all. Equally, building something similar by Microsoft is perhaps too small for them at this stage in the game. So there's an M&A opportunity in the works. That presents an opportunity if Kanuni can be in the first position there, but also quite a big threat, because Microsoft may choose to build if indeed they see a strong demand from their existing client base of lawyers, and or another business that offers the same solution in any other geography that perhaps has some strong tailwinds in fairly a cliquey professional industry anyway, where a word of mouth and reputation plays a strong part, could indeed pose a competitive threat.
Or maybe, what's called now the invisible AI. It's like Gemini inside Google Docs and Copilot inside Microsoft Word. Maybe this general use AI inside those document apps might replace the need for Kanuni, because although it's general, but there are some use cases for lawyers to use those general AIs. So yeah, I don't know. It's nice to see that people are trying to create embedded AI into other apps that people use every day. We'll see how this goes and how can they compete with the big ones.
Yeah, for sure. And I'm looking forward to seeing it unfold. One thing that that came to mind, actually, I wanted to raise 10 plus years ago. I saw, all these forecasts around the predictions and the impact of AI way before consumer AI was mainstream. And there were two career options that arguably had the highest threat, and one was accountants and one was lawyers. So it's awesome in a way to see this unfold. I don't think we're at that point yet where AGI is going to take all lawyers and all accountants' jobs today, tomorrow, this week. But this is an indication that forecast back 10 plus years ago is somewhat creeping into reality.
Okay, you know what? On this point, Elliot, let's talk about the business model of the law firms. They charge or bill by the hour.
Yeah.
So the efficiency might not always align with that model, right? So could efficiency-driven tools like Kanuni eventually reshape the business model of law firms?
Well, ultimately, I guess it comes down to how much pipeline you have as a law firm. If you have too much inbound and too many deals to work on that you don't have enough capacity for, and there's a waiting list, Kanuni would be your best friend, or a tool like Kanuni, because it makes your team more efficient. And now you can take on 30% more clients. You're not increasing your OpEx. You're not increasing your team. You're not increasing your office rental space, whatever. and happy days. If you are a small time without the queue, maybe it's not for you. Maybe you would want to say keep your prices slightly higher. I'm not sure. There will also be a middle ground of the smaller law firms that perhaps have a CSR or goodwill spirit, where actually paying and charging per minute or per 7-minute intervals, as they typically do, is not their modus operandi. And they'll say, well, actually, we can offer a better work-life balance for our team, and our team are empowered to be able to deliver better and more effectively, but we're not going to necessarily seek the greedy opportunity of just more and more and more clients. Either way, Kanuni benefits in such instances.
I use ChatGPT to draft document, review documents, and only when I need like a stamp of a lawyer, I go to a lawyer. What do you think?
I think, well, the parallel I draw is like it's not that lawyers are going anywhere, but paralegals are going to be your software. And much the same way, like some of the, medical code billing folks in hospitals are going to be these AI agents, but doctors, are still going to have as much in the top of the funnel. So I just think like, yeah, in terms of specific use cases, like to Elliott's point, like accounting and legal are like tailor-made for what this technology is good at, like I can't day trade with ChatGPT. I mean, you could, but it'd be a bad idea. That would be a very bad use case. But for these kind of, repetitive.
Some people are, and they're posting it on TikTok and on YouTube.
And if we could figure out a way to do it, we would.
Brant, on the business model, do you think this might change the business model of the law firms?
I honestly don't think it will that much, just because I don't know. And this is I'm just drawing from my kind of personal experience, which is, I think at least in the US, like the percentage of lawyers that hate their jobs is so high. And a lot of it is because they're just doing a lot of mundane, repetitive tasks, even though they're charging a lot of money for it. And same in the medical profession, which is, people get in the medical profession because they want to help people, not because they want to know how to code a biopsy scan, and get insurance. Like, so I think it will do the unlock. I think it'll make them more efficient, be able to take on more clients. If you're a paralegal or you're an independent paralegal, you can now work for 12 law offices simultaneously. You could bill them whatever you want and just throw it into like what Kanuni's doing and get better results than probably any human being. So I actually don't think it's going to change the business model as much, but I think if anything, what it changes is staffing. I don't think you're going to need an army of paralegals or an army of accountants at tax time to do the same things. Similarly for us, the reason you see VC firms that have huge AUM and they have just armies of analysts and principals, or like you look at A16Z and like they got like 130 partners, right? The reason for that is because to be able to see the amount of deal flow on a human level, those folks are just responding to cold inbound, clicking through decks, writing memos, and filtering stuff up to their partners. At Trac.vc, although we spend a lot of overhead and resources to buy data and have data scientists, but we don't have to have an army of analysts because our technology is doing that for us. It's like an army of analysts. So I think what you're going to see is a lot of this in between space in these businesses become a lot more efficient and a lot leaner, because you just don't need as many human beings with eyeballs looking at things and checking things.
Okay, to wrap up the story, let me ask about the ethical dilemma here. So this product in Kanuni is directed towards the lawyers, not consumers. And because this is, or because of the sensitive nature of this legal work, how important is transparency here? When lawyers use AI tools, can they tell their customers that they're using AI tools? And what can they do to mitigate any risks or potential problems that may come up later on? What can Kanuni do?
Yeah, I mean, my thought is there's no knock on lawyers, but as long as lawyers, if they're using it, they're still responsible if they're my lawyer. for what they produce, regardless of what tool they use, regardless of what paralegal they use. Hey, I'm paying you. You have to own the product of the work that you produce. And if it were for me, yeah, I would be like, well, you're kind of dumb not to use these tools. So I think ethically, yeah, it's I don't know that it's like I need to disclose it per se, but there's no hand wringing that can be done because like, well, the AI hallucinated. We're like, well, that's why you went to law school, so you can review what the AI did, and give it back to me. I don't know. That's what I think. What do you think, Elliot?
My take is, and combining the two questions, Ahmed, my take is that whilst the business model of law may not change imminently, right? And when I say imminently, it's probably in the next 5 years. I do think that with Gen Z and Gen Alpha being AI tool native, which I wasn't, and I don't think anyone on this call was growing up, that will force a change in the business model, right? When those youngsters are graduating university or college and or climbing up the ranks or starting their own law firms, they will be operating completely differently to how their father or mother's generation did. And that will be largely led by, fluency in tools. On the question of like ethical and moral nature of using tools, I would totally agree with Brant. At the end of the day, in a capitalistic society, if a good law firm can offer me quality work in a timely manner that has a good stamp of approval and potentially cheaper than competitors, whether they do that with a tool or not, they're probably going to win, as opposed to those who are resting on their laurels and living on their 100, 200-year legacy and still charging a fortune. There will be a space for those that are more nimble, who are able to offer the same, if not better service with that stamp of human approval, which indeed is why they went to law school, that perhaps eventually outdoes the high rates of the traditional reputation of certain legal firms.
Okay, let's now take a break from AI and talk about pulling water out of thin air, quite literally. Jamie?
Yeah, 100%. And we're going back to Tunisia for this one. So we have Cumulus Water. They've raised $3.5 million seed round to expand their atmospheric water generators. To your point, Ahmed, which extract drinking water from air using a thermal process. So backers include BPI France, Plus VC, Plastics Labs, Careem Ventures, several regional angels as well. Co-founded by Ihab Tricky and Mohammed Ali Abids. Basically, the flagship product is called Cumulus Box. So it's a cloud-connected unit, produces up to 30 liters of water a day. It has built-in predictive maintenance and real-time optimization across geographies too, which I thought was quite interesting. So if something seems to be working better in Saudi Arabia, for instance, they have the capacity to maybe tweak what they're doing in another country. It operates on a B2B model at the moment, so serving schools, NGOs, hospitality clients in water scarce areas, and apparently is approaching $1 million in contractual value. I don't think they disclosed a time horizon for that, however. The intention now is to expand across Southern Europe and the Gulf. Saudi Arabia in particular seems to be a core focus going forward. I think there's some sort of regulatory environment alignment that they're trying to tap into there, and they've earmarked a $5 million pre-Series A further down the tracks as well.
It sounds like magic, pulling water out of thin air. From a VC perspective, how scalable is this technology, especially for mass adoption in regions facing water scarcity? And they're trying to expand to Saudi. In the middle of Saudi, in Riyadh, for example, it's dry. It's not humid. Only, I think, on the coasts, it's more humid, and in the UAE and Abu Dhabi and Dubai, but not in Riyadh, for example. And I don't know. How scalable is this technology? What do you think?
I don't know specifically for this technology, but I know I would put this in the similar bucket of like, desalinization or like how solar was. It always seems to come down to unit economics to make it viable, because there's so many amazing like science fiction type applications out there that when you see it, you're like, is that real? Can we really do that with science? Why haven't I seen that? And the reason you haven't seen it is typically because of the unit economics of like the amount of money it costs to actually pull water out of thin air. It's not that we can't do it. It's just that like that's gonna be really expensive water that you pull out of thin air. So I think that's really always the question. And so like I know solar has been on a long journey and is still on a long journey of it being like completely not viable without massive subsidies, at least here in the US, to now, becoming better and better, and also with battery technology and stuff too. So I would think this would be, I'm guessing, in a similar boat of if you could get the unit economics to make sense, yeah, you probably could scale up, but it's also, not only are you making physical things in the world, you're dealing with moisture in physical machines at scale, which is no simple task. I don't know, what do you think, Elliot?
I'm really pleased to see something like this come out of this region. It's seldom, often we see like pure science and academic research stem into a commercial endeavor, and that is what makes the Bay Area, and something that I think the world aspires to replicate and some form of scale. So that's amazing, and fair play to these founders. The magic of pulling water out of thin air really it is not too magical. I mean, it rains and has been raining for eternity. I like the way that they've been able to create that sensation nonetheless, that it's magical, because that it creates appeal both to the consumer and to the investor. Like, realistically, what I really like about a business like this is, even though it's a hardware play, once you buy it, it's kind of like you're stuck into their ecosystem for maintenance and updates. But that represents a huge opportunity in the stickiness, but that also creates a problem, because it is hardware and it is limited. So you're dependent upon, as a customer, the availability of parts, the ability to ship parts and spares to your destination. And if you're in the desert in Jordan, for example, providing a luxury camp, and this is your source of pure water for your guests, then how easy is it for you to source a new valve or a seal from the supplier? Not too sure. And there's strong reason to believe that there could be quite competitive copycats, if indeed the technology, if it's not protected globally, which is what VCs want and are looking for, then having a copycat solution to purify water from air perhaps is already available elsewhere, or you could have aftermarket parts as well that could become a threat to the business. Water. That said, I'll wrap up by saying water is and continues to be considered liquid gold. In fact, there's that fantastic startup that, what was it, like 7 years ago, called Liquid Gold, and all they did was can water. Phenomenal branding. Maybe a bit longer now, but there's a clear demand for water, population increase, water scarcity, water purification, that water treatment, water filtration. On average, those markets are growing at around 11% CAGR, and so this represents, for me, something quite refreshing.
Yeah, and I like what you mentioned, Elliot, on the competition, potential competitors, because I was intrigued by this technology, and I found a YouTube video explaining their tech, and it's basically the same process that happens in ACs, air conditioners. You notice in an AC, there's some water that comes out of the external unit, and they took that process and made it much more efficient to produce 30 liters of water per day, which is amazing. I love that. But it uses electricity, and it uses filters, and of course, the mineralization process. And these are the parts that need to change every now and then. So the technology is not, superior. The competition would be on how to make it more and more efficient every time a new competitor would come up. The question is, many of those sustainability-focused companies, they struggle with profitability. What's your take on how do ventures like Cumulus balance social impact and commercial viability without compromising either?
That's quite a very difficult question to answer. At the end of the day, like, really what it comes down to in VC is returns. If we can talk about wishful thinking and CSR initiatives and sustainable and social impact, and they are super, super important things, do not get me wrong. But if there was one fundamental bottom denominator, it would be commercial return. So indeed, as Brant and I have mentioned throughout this conversation, if there's not a road to profitability and a sustainable road to scalability in the form of production, distribution, servicing, and of course retaining your clients, then maybe it's not for venture businesses. That said, I could also see something like this being, depending on how novel, I haven't done enough research into how novel the technology and or how protected the technology truly is. I could see this being quite viable from a PE or from a global water purification company who can turbocharge a cumulus because they've got the distribution and supply chain networks already in there.
Yeah, I think this also highlights, VC venture capital is super important in kind of the innovation ecosystem, but VC alone and capitalism alone is not gonna, generate, innovative goods for the world. I was talking to a founder last night. He came out of a Stanford PhD program, and he's making this, turning liquid batteries into like kind of a solid polymer. So it, like, if it gets damaged, doesn't create a fire like lithium ion batteries and all that stuff. But my point in saying that is the company's been around 10 years, but he spent 5 or 6 years, basically this was his doctorate research at Stanford, where he was getting paid to use their facilities and their money to do this research and whatever. And then it got to a point where it could go from commercial viability, but without that educational institution, VC couldn't come in on day one and fund that project. So I think that it's VC is like such a specific tool, and it's an important tool. But like I feel like for these sustainability projects, it can help, but it can't necessarily be the complete base or the foundation of getting that kind of technology off the ground. Because at the end of the day, it is returns. My LPs are giving me their money to lock up for 10 years. So I know they want a better planet too, but they also want their money back. And more than they gave me.
Plus return. Yeah.
Yeah.
I do think that a business that can strike that intersection of making VCs happy in return and all their shareholders happy, both customers, team, and their investors, as well as having a strong social and societal and ecological impact. That's the sweet spot. That's the eureka. It seldom happens, but it's certainly not impossible. But where the VCs get involved in that equation is important. They get in too early, probably they're going to get burned because, as Brant mentioned, there's a long R&D cycle. If they get in too late, they're not going to get the returns that they anticipate, and they'll be pushing perhaps for an exit that maybe isn't necessarily the right one for the business. If they get in at the right point, which again, it totally depends upon what the product is, what the market is, where they're operating, what the margins are, how they plan on growing, who the captains of the ship are, and who the team are that are running it, then potentially, the VCs can add a lot of value. But it's certainly not a one size fits all. Like, VCs get plugged in at this stage, 20% through the retrospective journey of the business. That's the best for everyone. No, it varies from case to case for sure.
And I really think Cumulus has a chance because the product is not super crazy expensive. It's almost $4,000. And I think if they can make it smaller and cheaper, maybe it can be a product to consumers, not just to businesses. Before we wrap up, a big thanks to OCTA for sponsoring today's episode.
If you want to get paid faster, access financing, and automate your receivable process, head to weareocta.com. That is weareocta.com, and take control of your accounts receivable today.
With that, thank you so much, Brant and Elliot. This has been a great episode. I really did not feel the time.
Been our
Thanks,
pleasure.
guys. Appreciate you having me.